Good morning, good afternoon, or good evening, and welcome to the Tuesday, the 6th of August, Bull versus Bear webinar. Steve Miley here on the Call for Trading. Welcome, everyone. Going to go through our usual regular run through in here today. We'll take a look at the markets, take a look at what's going on the macroeconomic central bank, the geopolitical front that's influencing financial markets right now by referring to the major news wires. We'll take a look also at the what's going on the central bank side, what's going on the interest rate side. Check out the CME Fed tool, and then we'll also take a look, a recap around the world of financial markets, what's been going on the overnight since any traders within the US have been to sleep, and then we'll also take a quick look at the chart. So we're going to kick off, and it's something I kind of missed a little bit here, and they're starting to write about it, but basically saying that. As much as the US, and I said that US data wasn't that negative to cause that kind of a move that we saw on Friday and then again on Monday. And I think it's a combination of, excuse me, of that data combined with the earnings data we've been previously having from the Magnificent Seven. But critically, what I haven't really been picking up on is this unwind of the carry trade. Now, what's a carry trade? A carry trade is like basically, it's, if you think about the name carry trade, it's carrying from one to another, right? And what happens in a carry trade is investors will borrow cheap, and then they'll carry those cheap funds, okay, across to somewhere else where they will invest it, right? That's basically a carry trade. And then say for the foreign exchange markets, what we're seeing a lot of more recently, we saw an unwind, started to see an unwind of the fact that it's been very cheap to borrow in certain locales compared to other sort of geographical and economic spaces. And the classic one is the Japanese yen. Interest rates have been historically low, and the classic carry trade, the yen carry trade, it's often called, is when you borrow. Funds will borrow in yen at or below zero interest rate. So you borrow funds for effectively nothing, and then you then have to move them, say, across into US dollars, and then when you move them across into US dollars, then you invest in US dollars. So you borrow for nothing, and then you can invest in, say, the US stock market. So that sounds like a good deal. Obviously, your risk is if the currency moves. And if a lot of people are doing that trade, so they're borrowing in yen, then they have to sell those yen to buy US dollars to then go. So then what you see is then yen weakness. And we've been seeing a lot of yen weakness of late, right? Not of late, up until recently. And it's a similar story, say, for the Swiss franc. And I think they mentioned in these two articles here, as they're the classic examples. The Swiss franc was at or below zero interest rates. Okay, so in the Swiss economy. So look, so you can borrow. So see, look, investors have borrowed money from economies where low interest rates, as Japan or Switzerland, to fund the investment in high yields. Well, you remember it was the Swiss National Bank amongst the major global central banks of the world who were first to hike rates. Okay, all the way back, I believe it was March. Okay, and then we've also had the ECB. So ECB rates are relatively low compared, for example, to the US. And the ECB have already increased interest rates. And then just in the last week, the Japanese have now increased interest rates from below. Previously, they were below negative to zero, and now into positive territory. So we're seeing now that not being as good a deal. That carry trade from various economies, and particularly more recently from the yen. And the yen has appreciated. So then that damages, as the yen then appreciates, that damages the popularity, and any company who's done any trades in that doing that carry trade, any say hedge fund, for example, is going to suffer. And so what we see, look, they have been caught out as the Japanese yen has rallied more than 11% against the dollar from a 38-year lows. So whilst the yen's weak, it's been okay, but then what's happened is the yen has gone the other way. So we're seeing funds caught the wrong way round on that trade. They're being triggered to get out, and as they trigger to get out, right, they've got, say, they're holding funds in US terms, so maybe in US stocks. So they have to sell those stocks, then realize the dollars, then they sell dollars and buy yen, okay, as the yen is going up. That drives the yen still higher. But to do this, to unwind that trade, they're selling maybe US assets. They're maybe selling European assets, right, equities. And that's why we're seeing this big sell-off, okay? This is it's not why, it's added to it. And that's why you've seen the more explosive moves, because basically hedge funds and other funds are basically being forced to unwind these. Okay, and yes, there is threat of a hard landing, there is threat of a recession, but excuse me, the moves have been far too exaggerated. Okay, they've been far too aggressive on just that jobs data, and that jobs data wasn't particularly bad. So that's what this article, so I'm going to actually share this one. Hopefully you can get this in Reuters. Reuters is, I think you just have to register with Reuters. I know I've got a Reuters account. I'm always logged in as me, but I'm not sure if I pay for it or not. Can't remember. Trade Day pays, right? um, but I can't remember if you have to. You can just view this. Just let me know, guys, if you click on those links I've just put in the chat, whether you can actually to view those, or whether you have to pay for them. They may be paid, but these two articles basically saying the same thing in here. Aftershocks of the carry trade at the heart of the market route could still have reversed. So there's still more to come. But this unwind is a once and for all. It's not going to continue to get worse. As time goes forward, right? And you can see that. I'm going to jump ahead to the overnights in here. And already, look, the Nikkei has rebounded 10%. Remember, it lost 13%. You say it rebounded 10% overnight, right? So we had a 10% down and back up again, all around. The fact of the moves in the yen, obviously a strengthening yen is negative for the Nikkei, so that's why we sort of part of the reason we saw a more aggressive move. It's the biggest move down in the Nikkei since the 1987 crash, which probably most of you, I do remember. It's my early days of investing, but most of you guys won't remember that. Okay, so so that's so we've seen that maybe we're done, is what I'm kind of saying. Maybe we've done. What we got on the calendar coming up. Very, very, very light calendar here. Trade data out of the US rarely does anything. I don't see any Fed speakers on the calendar here. We looked yesterday on the Fed calendar, didn't see anything there, so I'm not sure we're getting any Fed calendar, but very, very light on the calendar. On the earnings calendar, I'm going to start not looking at this. Duncan's going to probably stop looking at this when he takes over, because we're way into earnings season. The only one to watch out for is Nvidia going forward. But what we do have is we had Caterpillar today, so you can see beating on earnings per share, missing, but I mean the slightest of misses on the revenue numbers in here, but beatings on earnings per share, so that's a positive. And Caterpillar, remember, seen as a bellwether for the whole of the US construction industry. So it says 2024 profits will be higher than expected, so positives coming out of Caterpillar on the overnight. In here, let's have a look at 5 things to start your day. So tepid turnaround, so markets calmer. It does feel like, for me, we're potentially putting in a bottom now, and we could see a turnaround in here after Monday's dramatic sell-off in here. The rebound was slightly more tepid than the rout, but we could see a notable rebound. And they're talking about the rebound we've seen in the in Japan. The big question now is whether Monday's wild gyrations mark the final bang of a global sell-off that started to build last week, or seeing the beginning of a protracted slump. I'm in the camp of the former. Okay, I think we're almost done, if not done already. I think it's just a fast, quick correction. I think we had the fact that we had the slowdown, and with the Magnificent Seven numbers weren't as good as expected. I think the jobs data, was the final straw that broke the catalyst and final straw that broke the camel's back. But I think this carry trade that we'll spoken about tomorrow is the real underlying reason, and that's not potentially ongoing. Once those positions have been liquidated, those positions have been liquidated. So for me, in here, we may be done. Currency markets, they're talking about that carry rate, although they are saying that it maybe has some more room to run. But I think for now we're getting close to being done. Back from Jim, I can read the forex articles. Brilliant. Thank you, Jim. Thank you for the feedback. So at one point on Monday, markets were speculating about an emergency rate cut from the Fed. I said I do not see that happening. Although those bets trailed off during the day, I do not see that happening at all. The last thing the Fed want to do, it has to be a proper emergency. This was one data point, right? And the stock market fell 4%. The Fed are not going to do that, because that sends a worse signal to the market. Okay, so again, we're not seeing that. Our market team has put together a list of what bankers say you should and shouldn't do when market crashes. Well, the market hasn't fully crashed yet, so you can read that if you want. Anyhow, 6.4 trillion stock wipeout. The numbers sound massive, but in reality, they are what they are. We were down 4%, 5% at one point and rebounded from that. Trading for a great unwind is just starting. I don't think it is just starting. I think that's it. I think it's done. That's my view, though. Stocks see choppy trading as nerves still run high. Obviously, they're going to run high after that big move down, but Japan bounced significantly in here. What else do we have? And that's just the overall roundup in here. Stocks drop as early sense of relief falters. So on the US recession worries surge again, what is in the data? Well, there's not a lot in that data. As we said, in the Asian stock markets have rebounded on the overnight. European stocks in here pretty much unchanged. They've just gone stable rather than showing any kind of signs of a rebound. And if we look on the overnights on the US, Nasdaq's up 1%, and similarly with the S&P. So we are seeing a follow through on the futures to the upside. For me, it's nearly done. I think we could well be done in here. So now you can see we're backed off from this. We were basically nailed on for a 50 basis point hike. Cut. God, I have to remember we're cutting going forward. Cut. You can see in here now we are pricing in again. This was 100% for a 50 basis point cut in September. Now we've got a 25% chance of only 25 down and a 75% chance of 50. So the market is kind of backed off on its ultra view of an ultra dovish Fed. But we go to November. The betting is though here. So this is now for 50 down by September. Here's for 75 down by November. Excuse me. And by the year end, the most chance in here for what's that? That's for 100. So we're looking for 50. So maybe 50, 25, 25, or 20, 50, 25, whatever. At the moment, the most chances, but we are looking for chances of maybe more rate cuts. So at least for a total of 125 down the market. It's potentially more though. So at least for 100 down, excuse me. This is for 100 down, 43.9, at least for 100 down. So maybe 25, 25, 50 or 50, 25, 25. But there is risk for more aggressive rate cuts. Look at the yield chart, and what we see is yesterday, obviously, this already started to move back higher in yield, and we've got a follow through in here today. So on the yield chart, we've got this kind of this hammer pattern, or we've got this dragonfly doji, which is a significant turning point. So that will propel us back higher in yields in here. And if we go on the should go through the treasury chart in here first of all, you see even though we're sort of staying in here, we're wary of being overbought. We're very, very overbought in here on the price chart, and we've got those basically negative candlesticks. If we went to the daily charts, this being like some kind of blowout top. So there is real threat, even though we can't turn around and say we're going to go bearish on this, but there is real threat that we see a significant downside correction on the treasuries. And if we go to the treasury chart in here, you'll see it there. Look, so on the daily, we had this big blowout. This is like a shooting star pattern, okay, on the candlesticks, and then reinforced by the movement lower already in price today. So this is saying to us, pretty much the upside is done on price. So it's aiming back to higher yields. And normally that'd be a negative for stocks, but in here I think that's potentially a positive for stocks. And this for me does feel like this bearish forces remain, setting essentially a major April low in focus. Came right off, remember, that April low in here and rebounded. It feels to me like we could be turning. And if we go and take a look on the individual charts in here for the S&P and Nasdaq on the dailies, you can see in here, let's go on the dailies first of all. Here's the Nasdaq, and remember it came right off that low. Here we are, that low in here from over in April came right off of there. This big rebound pattern in here. So we've got this big it's more like a hammer, a big hammer pattern in here, but a really aggressive. You could say it's a dragonfly doji, but more like a hammer pattern, really strong hammer pattern. And if we take out this morning's highs, I think we could see a significant correction on the upside. And if we look on the 30-minute chart, we'll see what that looks like. So you've got this double bottom. Remember, we've come right off that low anyway from April over here, okay? And then on the, just move this across. Hopefully that works. Yeah. And then you get this little double bottom go in from yesterday, boom, boom. And then so we've already kind of made the measure. If you think of the measure here, extended up, we've hit the measure. If we can now take out the overnight high, which is up at 18,437, I think we could see a significant rebound, further rebound in here to the upside today. Similar story on the ES. You got this big like hammer pattern. Didn't really come off the same support level, but there is a support level here we held at. Again, it needs to take out the overnight high in here. And if we look at it on the 30-minute chart, again, you've got this in here. It's more of a inverse head and shoulders. So you've got shoulder, head, shoulder. So I'll very quickly. Where are we? I'm actually gone blind here. Where are my shapes? Oh, it says shapes. Can't really miss it, can you? So you got this kind of shoulder there. Very annoying. You can't just. I won't let you copy and paste. Didn't think it would. You got like a head here. Move that across. There's your head, and then another shoulder over here, right? So you got these head and shoulders, and then you draw the neckline on. Between the two shoulders, it's almost horizontal, but it's not quite. I'm going to extend that out. And you see we've basically broken that neckline but flirted, not categoric. I think if we get back above that neckline and back above the overnight high on the S&P is 53.05.5. If we take that out, I think it could be, then you get the measure of this. So this depth in here. So that depth is basically 52.76 to 51.20. So over 50 points, you can see a 50-point move higher. So another 1%, basically up a percent. It could easily be another percent higher in here today. Okay, another 50 points up if it breaks above the overnight high there at 05.5, 50.03.05.5. Okay, just my view. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. I'm kind of done now. So I'm going on vacation on Thursday, but Duncan's going to take over from tomorrow. So Duncan's going to be with you tomorrow right through to quite late in August for a couple of weeks, 2.5 weeks. And I'll be back with you towards the end of August. Until then, have not only a great trading day today, have a great trading August, and I'll speak to you again towards the end of the month. Bye.